D. In our last video, we broke the one more year trap. You realized you have enough. You've got the courage to quit.
But then, a new fear creeps in. The tax man. Most people think that if they withdraw $80,000 a year from their portfolio, the IRS is going to show up and take $15,000 or $20,000 of it. They think early retirement is a math problem where you're always losing. But what if I told you that in 2026, a married couple can pull six figures from their accounts and pay exactly $0 in federal income tax? This isn't a loophole or some offshore shady business. It's about understanding the rules of the game better than the people who wrote them. Today, we are finishing the Sarah story and building your 100% tax-free exit strategy. To win, you have to realize that not all income is taxed the same. If you earn $100,000 at a job, you're taxed at ordinary rates. But if you earn that money by selling stocks you've held for over a year, you enter the capital gains world. In 2026, the 0% long-term capital gains bracket for a married couple goes up to $98,900 in taxable income. Wait, it gets better. That's taxable income. Before you even get to that number, you have the standard deduction. But Sarah, you say, all my money is locked in a 401k. If I touch it before 59.5, I get hit with a 10% penalty. Not if you use a Roth conversion ladder. Every year, Sarah moves a chunk of money from her traditional IRA, which is taxable, to her Roth IRA. She pays the tax on that move today, which, if she's in a low bracket, is nearly $0. 5 years later, that converted money can be withdrawn penalty-free and tax-free, even at age 45. This is why we told Sarah in the last video to keep a 2-year cash cushion. You need that cash to live on while your first ladder rungs are seasoning for 5 years. You aren't just retiring, you're engineering a decade of low-tax life. What if the market is up and you don't need the money? You should still sell. This is called tax gain harvesting. If Sarah has a $0 tax bill this year because her income is low, she should sell her winning stocks and immediately buy them back. The result, she resets her cost basis higher. The benefit, when she eventually does need to sell for cash in 10 years, her gain will be tiny, keeping her under the tax thresholds forever. It's the opposite of what your parents did. They hoarded gains and got hit with a massive tax bill at 70. You are cleaning your plate as you go. The final piece of Sarah's puzzle is her HSA health savings account. This is the triple tax advantage unicorn. Tax-free in, tax-free growth, tax-free out for medical bills. In early retirement, healthcare is your biggest wild card. If Sarah pays for a doctor out of pocket at 47, she keeps the receipt. She doesn't reimburse herself yet, she lets that money grow. At 65, she can turn in those receipts from decades ago and pull that cash out tax-free to buy a boat or, more index funds. The math is settled, the taxes are solved. The one more year trap is behind us. Sarah is 47, she has $1.2 million. By using the 0% bracket, the Roth ladder, and her HSA, she isn't just retired, she is financially invincible. The IRS spent 20 years taking a cut of her hard work. For the next 40, they don't get a dime. Financial independence isn't about being rich, it's about being free. Free from the desk, free from the what-ifs, and free from the tax man. The bars of the cage were always open, you just needed to see the map. Comment tax-free below if you want my spreadsheet on the 2026 withdrawal tiers. And if you're ready to stop trading your life for numbers, hit that subscribe button. Your time is worth more than your balance sheet.